you got to ask yourself, what would happen to your family? What would it look like for your family if you were to pass away yesterday, right? So what kind of expenses they might have, what kind of expenses they might incur because of your passing. They might have added expenses that wasn't there before, such as funeral costs, income loss. Your income is now gone. So can they support their current standard of living on one income or no income, because maybe you're the sole provider for your family and now you're not there anymore. So what would their financial situation look like?
Welcome to Insuring Your Future, where we delve into the intricate world of insurance and compare two essential forms of protection: life insurance and mortgage insurance. Hi, my name is Rasha Ingratta. I'm a licensed mortgage agent with Mortgage Intelligence here in Windsor, Ontario. And in this video today, I'm going to be interviewing one of my mortgage agents, Trang Harder, which is also a licensed life insurance agent. We will be exploring the characteristics and advantages and disadvantages of each type of insurance, helping you unravel the protection puzzle and make informed decisions about your financial security and well-being. Hello, Trang.
Hi, how are you?
How are you?
Good, you?
Good. So, I'd like to start off by asking you the question is, what is life insurance?
Well, life insurance is a financial product where it pays out a lump sum payment to your beneficiary in the event of your passing. So simply put, it provides your family or loved ones financial security if you're not there.
Can we talk about life insurance and how it protects your loved ones and your beneficiaries when you're out of the picture? So it's almost like those commercials where you see the family in the picture and all of a sudden the dad or the mother is gone. So how do the beneficiaries benefit from the life insurance aspect of it when that happens?
Okay, so you got to ask yourself, what would happen to your family? What would it look like for your family if you were to pass away yesterday? Right? So what kind of expenses they might have, what kind of expenses they might incur because of your passing. They might have added expenses that wasn't there before, such as funeral costs, or maybe more childcare costs because one parent is not available anymore. So you'll need someone to take care of the children. Income loss, your income is now gone. So can they support their current standard of living on one income or no income, because maybe you're the sole provider for your family and now you're not there anymore. So what would their financial situation look like, right? Will having a policy in place help them mitigate any extra costs, right, if you're not there?
Perfect. And then can you explain a little bit about what is mortgage insurance? So we talked about what life insurance is, and as mortgage agents, when we are completing a mortgage application and getting a family or a client approved for a mortgage, and we go through all the documentation and all the intricate details of the mortgage approval and the commitment and all of that. And then we come to this document called mortgage insurance. Can you please explain that?
Yeah, so mortgage insurance is also a form of insurance. However, it's mainly to protect your home, that mortgage, right? The owner of that policy is the lender. So it's to protect the lender should you pass away and you can't make the mortgage payments anymore. The insurance company will pay out the lender what is left of the mortgage balance.
Okay. And I know one good thing about mortgage insurance is that when the insurance company pays off the mortgage, not only are they paying off the mortgage, but they're paying off anything that has to do with that mortgage. So penalties, that are incurred to pay out that mortgage. Let's say it's $10,000, they're paying that as well, correct?
Correct. Yes.
So that's a good thing. Can you tell me the pros and cons of life insurance? Not mortgage insurance, but life insurance.
So the main benefit of life insurance is that it is guaranteed. So once you are approved for that policy, you have that policy. They can't take it away, right? Unless there's fraud. That's the only time where they can take that away. But it's guaranteed. So when you make a claim, it's guaranteed because the claim is underwritten before you got that policy. So they approved you. So they're gonna pay out that claim. It's tax-free to your beneficiary, right? And the balance or the payment never decreases. So you pay a premium, but your payout, if you make a claim, will never decrease. Unlike mortgage insurance, technically the balance is decreasing as you pay down your mortgage, right? So your amount of coverage is decreasing as your balance decreases. But with life insurance, that amount is guaranteed.
And you kind of answered my next question was going to be, what are the pros and cons of mortgage insurance? But let's just stick to life insurance for a minute there. So life insurance policies, if I passed away and I've got a life insurance policy of, let's say, $1 million, my beneficiary, let's say it's my husband or my son, they get $1 million. If there's a mortgage, they can pay that off. If there's any debt, they can pay that off. If my funeral costs, they can pay for that. And then if there's any money left over, they can invest it, correct?
Correct. They will get a check in their hand for $1 million.
Okay. Can you tell me what the negatives are for life insurance?
Again, there's not very negatives, but the negatives is the process can be long.
Yep.
And complicated. It's not a simple application approved and done. Sometimes the insurance company might ask for more health information, so it can get invasive with your health. Most people might be reluctant because of that part.
Yeah. And life insurance policies are underwritten upfront. That is why it can get invasive with a lot of questioning. I know with so I know personally, because I had a surgery, and for a couple of years there, I had a hard time upping my life insurance. So I had to wait a certain period of time to increase it.
Right. And it gets invasive because they need to know their risk, right?
Yeah.
And just because you have a health issue, don't assume that you won't be approved, right? So they'll assess your risk, and you can be approved, but if you're more risky, you might get a rating. So that means you're still approved, but you might pay a little bit more in your premium. But most people assume that because they have a health issue that they won't be qualified. But
or they
can assume.
Or they'll exclude. So if you have a health issue, and let's say it's I don't know, you could give me a better example, but they can exclude that health issue. Let's say you passed away from that. Am I correct?
Right. They might make exceptions like that. Yeah. So you don't know until you apply. So I guess I'm trying to tell people that don't assume that you'll be declined just because of you have a few health issues. Yeah.
Beautiful. And with the pros and cons of mortgage insurance. So, I mean, I know a little bit about that because, we're both mortgage advisors and we understand mortgage insurance. Can you tell me a little bit more about mortgage insurance and the pros and cons of that?
So I already touched base a little bit with one con is that the balance declines. So the amount of coverage that you're getting declines, but your premium stays the same. So you're paying the same amount, but the benefit you're getting decreases over time. The pros, like a pro, is that it's quick and easy. If you are healthy, you simply just answer one health question and you're good to go, right? You can walk away that day with insurance if you like.
Okay. And you and I have talked about this before, because the life insurance process is long, and when we say long, it could be 2 weeks, 3 weeks, maybe a month.
Right.
Application and all the questioning, and maybe a nurse coming out to your house and taking your blood work and all the other stuff they need to do. In the short term period, when we're doing a mortgage application and an approval, what we usually try to do is, if somebody does want mortgage insurance, we do get them to take that for the time being, just in case something happens within those few weeks. And then when the life insurance gets approved, we cancel the mortgage insurance, correct?
Correct.
Yeah.
Yeah, because I would hate for something to happen in between the time you start the life insurance policy and then the time you're approved, till you're approved. If something should happen during that time and you don't have coverage to fall back on, then you don't have coverage, right? So we usually recommend people to, if they want to be covered and protected, to take the mortgage insurance because it is quick and easy. And then while they have the mortgage insurance in place, then we go shopping around for a better solution if there's a better solution.
Right. Okay, beautiful. So can you give me a real life example? I love numbers. And if you can give me a real life example of mortgage insurance versus life insurance on a certain age, amount, premiums, and so we can compare the two and give an idea to the consumer on like an example of premiums and all that.
Yeah, for sure. So we just did a mortgage for a couple. So I'm trying to use like an average couple with average mortgage size just for comparison. So for this couple, the male is age 33. And his mortgage is about $425,000, and I'm using a 25-year term. Okay, so that's because I'm trying to align with the mortgage amortization.
Correct.
Okay. Obviously, the consumer can choose a shorter term, but for a 25-year term for this male of 33 years old, non-smoker, his rate would be $35.19 a month.
Okay.
Now, if for some reason he can't afford that, which that's like just over $1 a day, right? But let's say for some reason he can't make that payment. We can always do a 10-year term. That would cost him $16.45 a month. So it's very reasonable. Life insurance is very reasonable to get, right?
And he's not a smoker, correct?
He's non-smoker.
And the spouse, in this case, a female, age 29, seeking the same coverage. She's at 25-year amortization. She's at
$21.04.
Okay.
So for female, it's generally cheaper. In this case, she's cheaper because she's female and she's younger. Okay, so that's why there's a price difference.
Yeah, it's always funny how females are always young. Like price when maybe because we drive the men nuts. That's why. That's okay.
I don't know.
I know.
Many reasons. There are many reasons.
Okay.
So for same couple, their mortgage insurance, for the male, it would be $55.08 a month. And for the female, it would be $36.72 a month. So you can see here to compare prices alone, the life insurance is the cheaper product.
The better way to go.
Yeah.
I like explaining it this way. I don't like saying that it's cheaper because, when you say cheaper, you think it's cheap, right?
Right. In this case, cheaper doesn't mean less quality, right?
You're actually getting a better product because you're actually getting the money on it. It's not a declining balance.
Right. That $425,000 coverage will always be $425,000 regardless of how much the mortgage.
Correct. And we've seen cases where mortgages come up for renewal and the client had a health issue a year ago and it's hard to move that mortgage to another lender for a better rate. We got to keep them with that lender because the insurance policy they got with them, now we have to collapse
Right.
new insurance policy with the new lender, and the premiums are going to be higher.
So yeah, so in this case, the life insurance is the better product because they would get that amount guaranteed within that term. And if they do choose to move their mortgage when it renews because of a different rate or whatever reason, they don't have to worry about what that life insurance will look like because it stays the same. It stays dependent or independent. It stays independent of the mortgage.
Okay, beautiful. You know, we talked about term insurance. Can you talk a little bit about universal life insurance? So there's term insurance where you can get a 10-year policy, a 20-year policy, a 30-year policy, or you can get a life insurance policy. One that I have purchased for my son, where it's like a 20-year policy that you can pay into, but it's for life.
Yeah, so when it comes to life insurance, there's two types, term insurance and permanent insurance. Okay. So term is what we have been discussing this whole time. And then there's permanent, which is basically what it sounds like. It's for the rest of your life. And there's different ways to set up a permanent policy. You can set it up like you were mentioning, paying it for a period of time, and that's it. Or you can pay for on a yearly basis as you go along for the rest of your life. And there's also a different ways to set it up, where there's also a growth section, a growth portion, where there's a cash value that grows or the coverage amount actually grows. So there's different ways to structure it. It's more complicated that we can't go into in this video, but it's important to discuss with your advisor about that option if you want some kind of permanent insurance.
Permanent insurance. And today we're discussing term insurance versus mortgage insurance. Those two are more comparable than going with like a whole life policy, but maybe that's another interview.
Another video.
Another video. So another question here, Trang, because you're choosing a term insurance policy, let's say a 20-year term, and I'm 33 years old. And when I turn 53, my term policy comes up. What are my options when the term is done?
Okay, so if you take a term policy at the end of your term, so let's say you take a term 10, at year 11, the term will always have an option to renew. So once you have a policy, you'll always have that coverage if you want it. So if you choose to continue to have it, it can renew into another term policy. But at that time, that renewal premium will be really high because the insurance company doesn't know what your health situation is like, right? So, so I guess you can let it renew if you want, or if you are healthy and you still want the coverage, then you simply rewrite another policy. And then you get another policy at a cheaper premium than the renewed rate that you would get, and then you cancel the old one.
Okay.
Right? Or if you simply don't need the insurance anymore, like you bought a term 10 for a reason, whether that's the amount of time you need coverage for, or whether it's price. If you don't want it anymore, you can just cancel the policy.
Okay.
Right? So some people just choose to only need insurance for 10 years.
Yeah. Or you took $1 million insurance policy for 10 years and now your kids are older and I only want $100,000. So you can reduce it and go with the lower premium.
Right.
Correct. How do you know what is suitable for you in terms of choosing the right insurance policy?
So this is where it's very important to talk to your financial advisor, and they will go over your needs, your wants, your budget, ultimately what it is that you are looking for the insurance to do for you, right? Whether it's to protect only your debt, like only your mortgage, or to cover childcare expenses, provide income loss replacement for your spouse if you're not there. So they'll go over all those factors, right? So there's no one one good answer for everybody. Everybody is different in their wants and needs, and you have to work with a financial advisor to come up with the best solution for you.
And plan. Okay.
Yeah.
One more question, Trang. So I'd like to know who you work for. Like, do you work for one insurance company or multiple, or who do you work for?
Sure. So like a mortgage agent, I don't work for one particular provider. I work with multiple providers. So I will look around at different companies like Canada Life, Empire, RBC, just depending on what the client needs. I'll look at what they need versus what the provider offers to see if it's the best fit. So I go with whoever has the best fit.
Okay. And you compare premiums. Like, I know when you did mine, we compared premiums, we compared different things like that.
Yeah.
Me there, because there's riders, right? Where
Right.
It's not just a life insurance policy. There's a rider for disability and critical illness. I mean, I know we didn't go into that, but
yeah.
I remember I picked a few where it had different riders that mature at certain times in my life where
right.
Yeah,
so it just depends on what the client is looking for or what they're looking for, right? Sometimes I definitely compare prices, but prices is not always the only thing, right? Depends on what they need. If they need a provider to do a certain thing, such as maybe for health-wise, they need a little bit more leniency on this area. So maybe there's a provider that is more lenient, that will work with them. So it just depends on the individual.
Okay. Is there anything else, Trang, that you want to add to this, or anything else that you want to?
No, I think we did a pretty good job.
Okay, great. Well, thanks for joining me today. It was a pleasure interviewing you, even though you are in the other room. Thanks for the information, Trang.
Yeah, no problem.
It's always a pleasure listening to you.
Thank you, Rasha.
Thank you. Have a good day.
You too.